In shaky markets, dividend income can provide. In uptrends, dividend income can compound. Regardless of the market you're in, dividend investing can play a huge role in your journey to build wealth. This does not mean that you should just invest in dividend stocks, just like I would never say you should just invest in growth stocks. Diversification among sectors is key to building wealth long term, and diversification amongst the types of stocks that you invest in is just as important. However, there are a lot of myths out there when it comes to dividend investing. And in today's video, we're going to debunk some of those myths. And in addition, I'm going to show you how you could build a portfolio that could have you earning $100,000 in dividend income. But before we do that, do me a huge favor, show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's get back to the video, taking a look at some misconceptions when it comes to dividend investing. And the first misconception has to do with people saying dividend investing is just for retirement. I hear it all the time, all over social media. I'm going to invest only in growth now, and then I'm going to move everything to dividend stocks. And that could work throughout a period of time, especially if we're going through constant uptrends. But that's not always going to be the case. And the other fact is that you will miss out on years and years of important compounding that's going to take place with dividend investing. The great Albert Einstein once said, potentially, compounding interest is the eighth wonder of the world. I would like to think he was talking about dividends, likely not, but we'll go with it anyways. So when it comes to dividend investing, I love it for two primary reasons. The first being that when I lay my head down every single night, I know my money is working for me. Regardless of whether the stock market is up 10% or down 20%, I know that I'm investing in high quality companies that pay safe, reliable, and growing dividends on a year in and year out basis. Of course, I want the shares to appreciate, but I know at least I'm earning some return. The second reason I'm a big believer in dividend investing is the fact that I'm a big believer in the power of compounding dividends. We just talked about that quote with Einstein, whether it's true or not. But when it comes to compounding, that's taking these dividends and reinvesting them, which increases the amount of shares that we own without adding any fresh new money ourselves. Obviously, adding fresh new money is going to further speed up the process, but now we have more shares and we're invested in companies that increase their dividend on a regular basis. So our dividend income is only going to grow. The second misconception I hear all the time is about dividends holding companies back from reinvesting for future growth. And this just tells me that you don't understand what free cash flow is. Free cash flow takes all of the cash that a company generates just from operating their business. And then they subtract out capital expenditures, which is what the company uses, the cash the company uses to reinvest back into the business for future growth. And then they take that, what's left over, which is called free cash flow. That is where dividends are paid from. What some people think is the fact that companies earn money, then they pay a dividend, and if there's any left over, then they reinvest it. That's the complete opposite. Free cash flow is so important because it's used to pay dividends. It's used for stock buybacks. It's used to pay down debt and make strategic acquisitions and so much more. Alphabet and Meta are two companies that have recently started paying dividends in the last year. Their CapEx budgets, how much they're reinvesting back into their company, has only increased. It hasn't slowed them down one bit. And that's going to lead us to misconception number 3, which is going to be that we're focusing too much on yield. I talk to students all the time when we're going through portfolio overviews about why they own specific stocks, and they tell me, well, it pays a high dividend yield. I say it often, never invest based on yield alone, because dividend yield is just a calculation. It has an inverse relationship to a stock price. So let's say that we have a stock that currently has a price of $100 per share and they pay a $4 per share dividend, which equates to a 4% dividend yield. Well, now the company reports their latest earnings, and the stock falls an incredible 40% over the next week or two, and it is now down to a $60 per share stock. Instantly, the dividend yield is now nearly 7%, much higher than the previous 4%. But the reason for the stock cratering was operating struggles, less cash flow. The business is losing market share and margins are cratering. This means that although the yield currently calculates to 7%, this is likely a company that will no longer be able to pay that dividend anymore, and it will likely get cut, which will result in further downward pressure on this stock. Be aware of high yield stocks and be focused on high quality stocks when building wealth over the long term. So those are just some of the misconceptions that I hear all the time. But now let's focus on building a dividend portfolio. And the first thing that I'm going to say is that building a dividend portfolio and investing in dividend stocks, it is a process. Dividend investing is not about the year one dividend income. It takes time to compound, allowing that power of compounding to work. Dividend investing is more about years 5 or 10 plus. The mistake that people always do is they take how much they're going to invest, they multiply it by the year one dividend income, and they say, well, this isn't worth it. It's like they're talking as if it was a fixed income. Remember, dividend investing is the dividend plus the share price appreciation that the company could offer. Again, it's a total return strategy. Obviously, when it comes to dividend investing, it is something that takes time. And you do need some money behind it to make this work. But we don't need to look at the year one dividend income and say, well, I need $100,000 right out of the gate. That would take a $3.5 million portfolio at a 3% yield in order to earn $100,000 in year one. And I'm going to go out on a limb here, and I'm going to say the majority of us, myself included, doesn't have a $3.5 million portfolio. So it takes time. It obviously takes money, and you need to find a way how we can continuously add fresh new money to our portfolio. That's going to speed this process up a ton. So let's look at a few examples here. Let's begin by taking a look with a portfolio that's valued at $20,000. And let's say that we have a goal of adding $1,000 per month to our portfolio. We're going to say that we have an average dividend yield for the portfolio around 3%, and our average dividend growth rate is going to be around 12%. As you can see, the first year dividend income, that's strictly just math, we're going to earn roughly $600 in dividend income for that year. Nothing to write home about for sure, but the power of compounding is a process. And we're going to be reinvesting that $600 while also adding that fresh new money to our portfolio every month. And when we invest in companies that regularly not only pay a dividend, but grow their dividend at a fast rate, that puts the power of compounding into overdrive. Companies like Broadcom, Visa, Home Depot, Starbucks, AbbVie, Coterra, NextEra, MasterCard. All of these companies are known for paying not only dividends year in and year out, but paying growing dividends. Broadcom is a company that has hovered around a 15% dividend growth rate for a number of years. And before their huge run-up in the stock price that we've seen over the past few years, they actually had a 4% dividend yield. So if we get back to the portfolio here and we reinvest that year one dividend income while also investing more money and the dividend increases in year two, you can see that now we're going to be earning over $1,000 in dividend income. Again, nothing to write home about, but you are seeing the process start to play out. We do the same thing year in and year out, reinvest those dividends and invest fresh new money. And the process is now going to start picking up speed. Year 3 dividend income is nearly $1,600. Year 4 dividend income is $2,200. Year 5 dividend income is nearly $3,000. We keep the process rolling. By year 10, we're up to $8,700. By year 15, $21,000. By year 20, we're at $48,000. And by year 25, we have now taken a $20,000 portfolio that is now earning dividend income of over $100,000. It takes more than 20 years to reach $50K in dividend income, but the next $50K is reached in just 5 years. That there is the power of compounding. Dividend investing is like a snowball rolling downhill. It starts slow and it starts small, but it starts to also pick up speed and grow larger and larger and roll faster and faster as time goes on. So looking back at the portfolio now, Through 25 years, we are now earning more than $100,000 in annual dividend income, meaning that our portfolio, whether it goes up 10% or down 10% in any given year, we are counting on that money right there, as long as we are investing in high quality companies with strong free cash flow. And our portfolio would be estimated at around $2.3 million. Now let's make some changes for those of you with larger portfolios. Now let's say we are starting with a $100,000 portfolio, and we're going to be contributing $1,500 per month. The same stats apply to both dividend growth and the dividend yield. By year 1, the dividend income's at $3,000. By year 5, we're up to $8,000 in annual dividend income. By year 10, we're up to over $20,000. By year 20, we're at $105,000. And by year 25, we're at $231,000 in annual dividend income. By year 25, we're talking about a portfolio that is valued at nearly $5 million. A $100,000 portfolio, now a $5 million portfolio. $3,000 in year 1 dividend income to now earning over $230,000 in annual dividend income. Dividend investing, again, is a process, but the power of compounding is very real. This is the exact process that Warren Buffett has used for decades. Now, when we're looking at these example portfolios, there's a lot of estimates that go into it. We're not always going to have a 3% yield or a 12% dividend growth rate. We're not always going to earn 10% every year on our portfolio. Some years you're going to be up 20%, like we've seen the past 2 years, or you're going to have years where you're down 10%. We're just looking to average things out. And this is hopefully going to give you an idea on where you could be 5, 10, 15, 20 plus years from now. So the biggest takeaway from today's video is number 1, dividend investing is a process. It is a total return strategy. Do not underestimate the power of compounding dividends. And what we like to say here at Roussin Financial is that we prefer time in the market over trying to time the market. So there we just laid out how to build a $100,000 dividend income portfolio. It's not something that's going to happen overnight. It's not something that's going to happen within 5 years unless you have a massive portfolio. But we have shown how you can start with smaller portfolios and allow the power of compounding to take place. Down in the comment section below, let me know your thoughts on this video and what your goal is for annual dividend income in the years ahead. And if you haven't done so, smash that like button down below and show your appreciation, and we'll see you in the next one. Take care.